Let me begin by making something clear. What I am about to explain is not speculation. It is not conspiracy theory. It is not ideological preference. It is structural economic analysis supported by decades of publicly available data, central bank disclosures, and observable policy patterns. And yet, when I present this analysis to audiences in the West, the most common response is surprise, not disagreement. Surprise. Because the story of China's strategic relationship with gold and the corresponding American misunderstanding of that relationship reveals something far more fundamental than monetary policy. It reveals how two economic systems perceive time, risk, and power itself. For more than 2 decades, China has been accumulating physical gold at a scale and consistency that defies conventional Western economic thinking. Not loudly, not dramatically, but methodically, month after month, year after year. The People's Bank of China has been purchasing gold in quantities that would make headlines if announced all at once. But because the accumulation has been patient and deliberate, it has been treated in Western financial media as a footnote, a curiosity, something vaguely noteworthy but not strategically meaningful. This dismissiveness is itself the story. Because while Western economists debate the irrelevance of gold in a modern fiat system, China has been quietly constructing one of the largest sovereign gold reserves on Earth, and that construction is not accidental. It is not nostalgic. It is not irrational. It is preparation. Let me explain what preparation means in this context. China's gold accumulation is not driven by a belief that gold will suddenly return as the backbone of global currency. That is not the plan. The plan is far more sophisticated. China understands that in a world where financial systems are becoming increasingly weaponized, where sanctions are deployed as geopolitical tools, where access to dollar-denominated systems can be severed with the stroke of a pen, diversification of reserves is not optional. It is existential. And gold, unlike bonds or equities or even foreign currency, cannot be frozen, cannot be sanctioned, cannot be digitally seized. It exists physically. It can be moved, it can be stored, it can be deployed as collateral or liquidity in systems outside the reach of Western financial infrastructure. This is not about returning to the gold standard. This is about building optionality in a world where the rules are changing. Now contrast this with the United States. The United States holds the largest official gold reserves in the world, more than 8,000 tons. And yet, American policymakers treat gold as a relic, a historical curiosity locked in vaults beneath Manhattan. There is no strategic discussion about gold's role in a multipolar world. There is no equivalent to China's methodical accumulation strategy. The dominant narrative in Washington and on Wall Street is that gold is irrelevant because the dollar is supreme, and herein lies the structural blindness. The United States has built its entire post-war economic and geopolitical power on the foundation of dollar dominance, the ability to print the world's reserve currency, the ability to finance deficits without immediate consequences, the ability to impose financial isolation on adversaries. And because this system has worked for so long, because it has been so deeply internalized, American institutions have lost the capacity to imagine what happens when that dominance erodes, not collapses, erodes, slowly, structurally, inevitably. China does not need the dollar to collapse for its gold strategy to succeed. It simply needs the dollar's monopoly to weaken. And that weakening is already underway, not because of conspiracy, not because of sudden crisis, but because the incentives that govern how nations interact with the dollar are shifting. When the United States freezes Russian central bank reserves, every other nation watches. When sanctions are expanded and financial access is restricted based on geopolitical alignment, every other nation calculates risk. And gold becomes more attractive, not because it offers yield, but because it offers independence. China understands this. It has understood this for 20 years, and it has acted accordingly. The mechanism of China's accumulation reveals planning horizons that do not exist in Western policymaking. Chinese purchases are not reactive. They are not tied to quarterly performance. They are not subject to election cycles or media pressure. When gold prices rise, China continues buying. When gold prices fall, China accelerates. This is the behavior of an institution that is thinking in decades, not years. The People's Bank of China does not need to justify its gold purchases to shareholders. It does not need to explain short-term opportunity costs to a rotating cast of political appointees. It operates within a framework where long-term strategic positioning overrides immediate financial return. And this framework compounds over time. Every ton of gold purchased today is not about profit next quarter. It is about leverage, optionality, and resilience in a future where the global financial architecture looks fundamentally different than it does now. The United States, by contrast, operates within a system where time horizons are measured in election cycles, quarterly earnings reports, and media attention spans. There is no equivalent strategic planning body with the authority and insulation to execute a 20-year gold accumulation strategy. The Federal Reserve operates independently, yes, but its mandate is price stability and employment, not geopolitical financial positioning. The Treasury Department rotates leadership every few years, each administration bringing new priorities and ideological preferences. Congress responds to immediate crises and voter sentiment, not long-term structural shifts in the global monetary system. And Wall Street, which exerts enormous influence over economic policy discourse, views gold as a non-yielding asset that competes with equities and bonds for capital. The result is that no institution within the American system has the incentive structure to think about gold the way China does. This is not a failure of individuals. This is a failure of institutional design. Let me be specific about the numbers, because they matter. According to official disclosures, China's central bank gold reserves have grown from approximately 1,000 tons in the early 2000s to well over 2,000 tons today. But here is what every serious analyst knows and what is rarely discussed openly. These official numbers almost certainly understate reality. China's state-owned enterprises, sovereign wealth vehicles, and non-transparent reserve structures allow for gold accumulation that does not appear in People's Bank of China headline figures. There is credible analysis suggesting China's true sovereign gold position may be significantly higher. Perhaps double the official number, perhaps more. We do not know with precision because opacity is itself part of the strategy. What we do know is that China produces more gold domestically than any other nation, approximately 400 tons per year, and none of that production is exported. It stays within China. Add to that consistent imports through Hong Kong, Shanghai, and other channels, and you begin to see the scale. This is not portfolio diversification. This is systematic, state-directed accumulation at the highest levels of economic planning. And yet, in Western financial media, this is treated as a curiosity, a strange habit of an opaque regime. There is condescension embedded in the coverage. The implication is that China is hoarding gold because it does not understand modern finance, because it is somehow backward or superstitious. This is projection masquerading as analysis. The reality is that China understands modern finance extraordinarily well. It understands that financial systems are built on confidence, leverage, and network effects. It understands that the dollar's dominance is not permanent law but historical contingency. And it understands that in a world where digital currencies, central bank digital currencies, and alternative payment systems are emerging, the nation with the deepest reserves of non-digital, non-seizable assets has structural advantages that others do not. Consider what happens if, over the next decade, more bilateral trade settles in yuan. If more central banks diversify away from dollar reserves. If the petrodollar system continues to weaken as energy trade becomes more regionalized. If sanctions accelerate the development of parallel financial systems. None of these trends require catastrophic collapse. They simply require gradual erosion. And in that environment, gold's role shifts. It becomes not the basis of currency, but the backstop, the asset that anchors confidence in a new system, the collateral that enables non-dollar liquidity arrangements, the reserve that signals seriousness and stability when launching new financial infrastructure. China is not preparing for the world as it is. It is preparing for the world as it will be. And the gap between those two realities is where strategic advantage is built. Now ask yourself why the United States has not responded. Not with equivalent accumulation, not with strategic repositioning, not even with serious policy debate. The answer is not ignorance, the answer is structural incapacity. American economic policy is shaped by powerful constituencies that benefit from the current system. The financial services industry benefits from dollar dominance. It generates fees, intermediation spreads, and structural advantages that disappear if the global monetary system fragments. Defense contractors and foreign policy establishments benefit from the ability to use financial sanctions as a substitute for military force. Exporters benefit from the dollar's reserve status, which allows persistent trade deficits without immediate currency crisis. And politicians benefit from the ability to finance spending without hard trade-offs, because foreign demand for dollar assets keeps yields artificially low. All of these constituencies have a vested interest in maintaining the narrative that dollar dominance is permanent, that gold is irrelevant, that China's strategy is misguided. To acknowledge the truth would require acknowledging that the foundation of American economic power is eroding, and that is not a politically viable conversation. There is also a deeper cultural dimension. American economic thinking is shaped by assumptions about markets, efficiency, and rationality that do not account for strategic patience. The dominant framework assumes that if gold accumulation were rational, markets would price it in. Investors would bid up gold prices in anticipation. Central banks would compete for supply. But this logic misses the point. China is not trying to outsmart markets. It is trying to outlast them. It is willing to accumulate at higher prices because it is not thinking about return on investment over 5 years. It is thinking about positioning over 50 years. This kind of thinking does not fit into discounted cash flow models. It does not fit into mean variance optimization. It does not fit into the intellectual frameworks that dominate Western finance, and so it is dismissed. But dismissal does not change reality. Gold prices have already risen substantially over the past 2 decades, and that rise is not disconnected from the trends I have described. Central bank demand is structural, it is consistent, it is growing, and it is not driven by the same factors that drive retail or speculative demand. Central banks are not buying gold to flip it next quarter. They are buying it to hold it for decades, to anchor reserves, to signal stability, to prepare for a world where financial leverage and geopolitical alignment do not perfectly overlap the way they did in the 20th century. And as that demand continues, as supply remains constrained, as Western investors slowly wake up to the structural shifts underway, gold prices will reflect that reality, not in a straight line, not without volatility, but directionally, persistently. Here is what the future looks like if these trends continue. China continues accumulating. Quietly, methodically. Other nations, watching China, begin their own accumulation programs. Gold becomes a larger share of non-dollar reserve portfolios. The dollar remains dominant, but its monopoly weakens, margin by margin, year by year. And in that environment, nations with large gold reserves have options that others do not. They can collateralize gold to access liquidity in non-dollar systems. They can use gold to backstop regional currencies or payment networks. They can signal credibility when launching digital currencies or sovereign bonds in local currency. Gold does not need to replace the dollar to be strategically decisive. It simply needs to provide alternatives, and alternatives are what erode monopolies. The American response to this shift has been inadequate because the American system is not designed to respond. It is designed to defend the status quo, to manage the current system, not to reimagine it. And this is not a moral judgment. It is a structural observation. Systems that have benefited from dominance for decades do not easily adapt to the erosion of that dominance. They double down. They assert confidence. They dismiss challenges as irrational or backward. And by the time the shift is undeniable, it is too late to reposition. I am not arguing that American decline is inevitable. I am arguing that American adaptation is being delayed by the very structures that enabled its dominance. And delay, in a world moving as quickly as this one, is indistinguishable from decline. What China has done is not magic. It is not mysterious. It is simply the application of long-term strategic thinking to a domain that Western institutions have treated as resolved. And that gap between perception and reality is where the future is being shaped. Not loudly, not dramatically, but persistently, ton by ton, year by year. The question is not whether gold will return as the basis of the global monetary system. The question is whether the nations that have prepared for a multipolar financial world will have advantages over those that assumed unipolarity would last forever. And the answer to that question is becoming clearer every day.